The higher the insurance costs go, it puts pressure to drive costs of properties down. So if you are, as an investor, seeing properties that you know that can be cleaned up, just like almost like when people buy properties that are in distress. I use the example fire hardening as a distress. Now, it's different than if a house was in poor condition and you fix it up and it increases value.
Welcome, my fellow Flowmasters, to another episode of the Cash Flow Authority podcast. I'm your host, Chris Jansen, founder of the Flow Authority, and this show is for high-performing professionals who did everything right. You've got the degree, the career, and the income, but you still feel like there's another level waiting. And so here we explore how real estate can become that next challenge worth building so that you can take ownership of your future and create a life by design. Now today we're joined, I have a pleasure to welcome here on the show, Mr. Robert Feldman. And just a little bit about Robert. He's a CEO and president of WOW's Insurance Services. He specializes in wildfire insurance for high-value homes in high-risk areas. So with the LA fires, I'm sure we'll talk about that today as well. But a very important thing that Robert's doing. And with more than 25 years experience, he really focuses on those hard-to-place homeowner risk markets and has developed alternative insurance solutions to address gaps left by the traditional carriers. So, Robert, welcome to the show. Happy to have you and excited to talk to you today.
Al, thank you very much. Yeah, it's a definite crazy market, Chris, right now. We're a wholesaler, and we also have our own programs, our own Lloyd's programs from London. And we have appointed over 4,000 insurance brokers on the Western United States and expanding. So we're definitely in the fight to help turn the tides.
That's great. That's great. So I do want to ask you, kind of going back, just figuring out how you got to where you are today. How did you end up in the insurance space and then specifically focusing on these higher risk insurance markets?
Well, been pushing almost 28 years this year will be the total number. And so been doing it for a long time. Had contacts that brought me in originally into the insurance world. It was kind of neat. At that time I was a captive agent. So I was only writing for one insurance company, things of that nature. And we expanded into doing the wholesaling gig really over the last 3 years and our own London programs. I've always been creative, so I like to be able to do things. I specialize in homes. I've just always been that way. I'm not a commercial writer. There's a specialty. People a lot of times make the mistake, Chris, where they think the word insurance is like lawyer, in the fact that it's like there's very specific types of lawyers that do different industries or different types. So basically, it's been we're very niche-y in what we've done. We were fixing a major problem for the Western United States, and California is just one of them. We have programs that start as low as the small home all the way up to $50 million of total insurance, and we have specialty programs. So definitely a kind of thing we do.
Wow. Hey, if any of my listeners need $50 million of insurance, you should be running this podcast right now. No, that's awesome, man. That's awesome.
Exactly.
So what are some of the more significant challenges that are currently shaping the insurance industry? And then also, if we can shift this back to property owners and investors, business owners, how are these shifts impacting those individuals?
Well, the problem with the insurance market, as I've testified, we're on committee there's a thing called the California Fair Plan Clearinghouse. We are actually one of the very few that's on that. We just recently got on that committee to help depopulate the California Fair Plan as an example. What's killing the industry right now is really a couple things. One is over-aggregation, meaning proximity of risks, grouping, heavily grouped policies. Well, that's, from an actuarial standpoint, dangerous. You want to spread risk and do things. We've been very big on spread of risk. We're also very big on fire hardening. Fire hardening, for a lot of those out there, is a new term. Basically, it's to make your house not burn. It's to take away vegetation. It's to do the things that are necessary to help a home survive in a catastrophe. One of the claims to fame during the Palisades fire, we had a 4% loss ratio. So we had an incredible low loss ratio based on fire hardening. And so that's a really big difference with what we look at and change. Gotcha. So for those homeowners and investors that are looking at things, you better understand about fire hardening. And that's a whole segment, Chris, for a different day is the joke. I can do hours on fire hardening. It's really a difference for a lot of, for people out there. Makes a big
Yeah.
difference.
Okay, that's good to know. That's good to know. I mean, you got to keep up with the property, but that's if you're in a specific region that has those higher risks. Yeah, it's good to know that you got to take extra precautions to make sure that
And well,
you're
that's,
not.
it's the Western United States now. There's not a lot of areas in California and the Western United States that's not considered a high fire risk. And so as we continue down that road, it's the change in trend. The fire
Gotcha.
hardening is the major difference.
So, like, I have a condo, I'm selling it, so I'm not concerned about this. Maybe the next buyer will be. But if I'm in the middle of like Santa Ana, I've never felt like I was really at risk for that because I see the fires, but they're
You're
always
you're
further out.
you're pretty safe.
Yeah. Okay. It's more if you're like
You know,
near.
your biggest, yeah, the fire zones. Your biggest problem, Chris, with the condo is that the HOA insurance, the overall structure insurance, has gotten kind of out of control. Cal Fair Plan has stepped in to try to help
Mm,
support it. But a lot of the HOAs across California, you as a consumer are required to have what's called an HO6 or walls in coverage is the term. Those
yes.
policies are pretty readily available still. The HOAs are where they're struggling is the HOA insurance itself. And it's kind of a factor of a lot of things. One, the rebuild costs are exploding. So a lot of carriers that will write insurance, whether it's home or HOAs or things of that nature, have limitations of what they're willing to write. So if you have a homeowner's insurance and the maximum they're willing to write is $2 million dollars a structure on your house, meaning 2 million rebuild cost. Well, people go, that's a lot of money. Well, wait a minute now. There's areas that are 500 minimum, 1,000 square to a square foot in some areas. And so if you say 500 square foot, that's only a 4,000 square foot house. Where, I mean, 10 years ago, a $2 million, man, you could get away. It would be, you're talking about $2 million, it could be almost a 10,000 square foot house. So it gets to be really crazy. The rebuild cost exploding has affected the insurance market with limitations, and just that's kind of where it goes.
Gotcha. Gotcha. And
Yeah.
and just so if I'm an investor and I own a property in one of these higher risk areas, I was always kind of curious, like if something did happen, because we got to play the numbers game, and so it's like we're pulling levers left and right, right? It's like, hey, we can have more coverage,
Mhm.
feel more confident, but now we're reducing our cash flow, right? We can reduce coverage here, and like there's so within insurance, there's so many different levers and add-ons you can do. So I always kind of wonder, okay, if something did happen and let's say I'm covered, I mean, do I need to rebuild? Or if I didn't want to, what if I didn't want to rebuild? Could I just get paid out for the damages and then walk away? Or does it not work that way?
It's a major disadvantage for consumers not to get to some portion of a rebuild. We recommend obviously the
Okay.
property being cleared. We also recommend to at least get it to the point of where you have the architectural plans and a builder bid. Get it to that
Okay.
point, because then what happens is you're able to maximize your insurance coverage. If you don't,
Mm,
you're relying on the insurance to dictate what the rebuild is, and that's not what you want to do.
yeah, I feel that for sure.
Yeah.
Okay. Okay, cool. And now,
Yep.
so
Yeah.
with the wildfire insurance crisis, what challenges exist in insuring these high value homes and specifically in these high risk zones?
Well, it's just, again, it's about mitigation, the fire hardening. It is about, because there's lack of carriers right now. So what happens if the further you are into a fire zone, the less likely you are to have an insurance carrier willing to write it. Also, at the same time, the larger the home is, the less likely. So it's a double negative. Large homes that are in fire zone areas are really struggling right now. But again, it doesn't mean that it has to be a large home. We have homes that are smaller homes that struggle. The one major advantage, though, is that the worst case for the smaller homes is they actually have a they have the California Fair Plan, which they can fall back to for coverage. Well, there's a limitation for Cal Fair Plan. There's a $3 million maximum coverage. Well, for a lot of homes that are larger homes, that's not enough coverage. So we've brought in excess companies that we'll stack on top of. We have carriers that'll go up against. There's a lot of challenges, but we continue to fix it as the time
Hmm.
goes on.
Okay. Makes sense. Makes sense.
Yeah.
Okay. So again, going back to the idea of like as a whether it's a consumer or I mean, we're really talking about investments on this podcast. So what are some other common insurance mistakes that property owners, investors, maybe business owners make as well?
Investors are typically definitely are doing mostly rental properties. Rental
Yes.
properties, it's really important to make sure that you have your liability set properly. You want to make sure, and one of the mistakes I always say to consumers is you really need to have what's called an umbrella policy. An umbrella
Good.
policy is excess liability that protects against, because in multiple states right now, you can have tenant issues regarding, God forbid, a fire or things of nature you can be liable for. It's having the protection. An umbrella policy extends on top of policies and covers additional things a lot of times, such as wrongful evictions and all kinds of hosts of things that'll help protect. So really, when you're a landlord, you need to make sure that is not the time to strip down policies. That is not the time to strip off coverages. It's an investment. So I agree with what you said earlier, Chris. There's a definite balance because you're obviously working on
Yes.
cash flow. But at the same time, I hate to say it, in my 20 years, I've seen people go bankrupt over not having proper coverages because they get hit with a judgment or they get hit with not things, and it's millions of dollars potentially where they can be in trouble. So it's really important to make sure that you're insured to value, insured to coverage properly.
So how do you figure out what the right number is for liability coverage, right? I mean, you can be real paranoid and
Well,
anxious and
liability
yeah.
is really, well, with liability, what you're really doing is, mistake is, people a lot of times will believe that the insurance is based on the valuation or your income or your total assets. It's really not that. What you're really doing with, and you're really working on, but it's one of those things where you're really working on doing valuation of what's the probability of a loss. Because what an umbrella policy does, for example, let's say you put a $5 million per occurrence, which we recommend for people that have it, 5 million, 10 million. You're looking at what is the probability or the likelihood of having some kind of litigation per event that's over $5 million. Well, that's very unlikely. If you have $1 million, it can happen. And so what you're doing is you're buying insurance based on what your perceived, what's the evaluation of a probability of something that would sting you for that level. You want to make
Yeah.
sure that you have proper insurance for those things. We don't do umbrella policies, but I get dragged into a lot of times, and we look at the excess liability and things of that nature. It's important for those out there. You got, as much as it is important, at least on the structure coverage or things of that nature, if you're short, that's kind of your own thing. When you're short on a liability situation, can be a really scary thing. There's what's called reservation of rights. The insurance company has the right to say, we're not sure if we're at fault here and we're going to investigate this. And at the same time, they have the right, an insurance company, if God forbid they figure out this is a $2 or $3 million claim situation, but you only have $1 million of coverage, they have the right to also pay out the policy limits and exhaust the coverage and make you then go out and defend yourself. So why we recommend higher coverages like a $5 million umbrella is, if for nothing else, is to make sure that you're forcing the insurance company to defend you. And that's a really important thing.
Gotcha. Now, I know you said
Yeah.
umbrella coverage is not exactly what you're providing, but since we're on the topic,
Yeah.
if you
Yeah.
if you own, let's see, if you own, like, so I have an umbrella policy, right? But I
Yep.
own all these properties pretty much through single member LLCs. So it's pretty much me that's owning the properties.
Okay. So they're right there. But the problem is, the moment you have an LLC, now you're in a commercial exposure.
Okay.
So now you have to look at a totally different, you're doing excess liability from a commercial standpoint. So there's a lot of times where a lot of investors, people have them into LLCs. And from an insurance standpoint, it doesn't make a lot of sense. Now, if you're going to have 20 properties, that makes complete and total sense. But if you're 2 or 3 properties, from a liability standpoint, you are much better to have it in your name, and you are much better to have them as an umbrella policy, because the cost of the LLC per year to maintain an LLC and the costs, there's a whole other reason I know for cost segregation and reasons why people do LLCs. Yeah, there's definite things that make sense. But if you're asking me from a pure insurance standpoint, a lot of times you're waiving a lot of your rights when you become an LLC or coverages for like umbrella policies and things.
Gotcha.
It gets much more expensive for excess liability. Your umbrella policy right now does not cover your LLCs. That's just as a general broad statement. They do not cover commercial-based things. LLCs are considered commercial.
Okay. Yeah, that's interesting because I'm a veteran, I go through USAA, and they've been really good when I've needed them for sure. But when I ask them about that,
Yeah,
they add my LLCs as additional insured and all this stuff, but they always tell me, no, you're fine. You're covered
that's
up
on the
to
property.
this
That's on
many
the
LLCs.
property. Yeah, what I would say is I would be very specific. I would want
Yeah.
something in writing from them.
Okay.
Because generally speaking, an LLC is not a coverage. I haven't seen an umbrella. I'm not familiar with USAA, so I'm going to be very careful with that part.
Oh
But
yeah,
as a
yeah.
general rule,
Just
they do not. If it's considered commercial, it's
yeah,
just you got to be really careful. Document.
for sure.
Send it to a rep by email and say, I'm just confirming that my LLCs under my umbrella policy that are insured this way, they're covered by my umbrella. If they respond back yes, you've got coverage. It's their errors and omissions at the worst case.
Nice, for sure. Okay. Yeah, great advice. And I don't mean this to be a
Yeah.
consultation just with me, but I figure if I'm having this question, other people are probably having the same question. Yeah.
Chris, that's the best way to do it, man.
Yeah.
I'll be honest with you.
Yeah.
I've done everything from AM Best to Bloomberg. One of the best,
Yeah.
some of the best podcasts are the ones that are using these kind of specific things. Because if you're 100% correct, if you're asking the question, so is everybody else.
Yeah. I'll ask one more that also might not be necessarily within your realm, but I'm assuming you know something about it, is renter's insurance. I've just been told, hey, always require renter's insurance and this much liability coverage and stuff
Yep.
on that. So how does that actually help or protect the owner? I understand definitely how it protects the renter for their stuff, their personal belongings, and then if they ever get sued, but how does it protect the owner? Why would an investor want to have that be a requirement?
Well, first and foremost, you as an investor want to have a layer of separation. I use the skateboard situation. If you have a kid that leaves the skateboard out and someone slips on the skateboard, if they don't have liability or don't have a renter's insurance policy, you're going to be named either way as an investor. There's no really way to defend yourself other than to use your insurance. If they have insurance and there's a liability, generally the insurance companies will accept responsibility for it, and it keeps you as an investor out of the way of it. And that's an important part of it. Renters insurance policies are very nominal in cost.
Yes.
And are very important to have. You want to be named what's called it's a really big difference. You have to be named additional interested party as a landlord. You want to be named additional interested party. If you are, that means that you get copies of all of making sure that the policies are enforced, basically, for renters.
Yeah, I always thought it had to be named, additional insured, but then recently my tenants
Can't do that.
You can't do that. Oh, okay,
No.
okay. I was saying, yeah, they give me
It just
a copy.
the insurance companies they're just not doing
They're
it.
just not doing it. Okay, yeah. So that's why that's like a very real question.
And what the reason for it is, yeah. The reason for it was a lot of landlords, I'm sorry to say, the bad apple spoiled the bunch. A lot of landlords weren't carrying insurance. And when you name somebody additionally insured, in essence, the renter's insurance liability is expanding to cover the landlord for landlord liability, not just for the renter liability. So that's why the insurance companies kind of crack down on that very thing.
Okay, that makes sense. Okay,
Yeah.
sounds good. So, kind of moving on to a little bit different topic. What new opportunities should investors and business owners be paying attention to in today's insurance landscape?
Really, as I mentioned to you earlier, really the fire hardening.
Fire hardening.
There are some diamonds in the rough. There's going to be homes. Yep. Because the major difference, when you think about purchasing a property, there's really three parts even as an investment side. You have the debt services. That's your mortgage, right? That's going to be one part of the cost. You're going to have a cost, the property tax. There's another cost. The last part, which people don't talk about a lot of times, is the third part of it is the actual insurance cost. Well, so if you think about it, the higher the insurance costs go, it artificially, or I shouldn't say artificially, it puts pressure to drive costs of properties down. So if you are, as an investor, seeing properties that you know that can be cleaned up, just like almost like when people buy properties that are in distress. I use the example of fire hardening as a distress now. It's different than if a house was in poor condition and you fix it up and it increases value. By fire hardening, you can a lot of times drive down your cost of insurance, which also increases value. So it's a thing to look at.
Gotcha. Okay. Okay. Okay, for sure.
Yeah.
And so, and like looking to the future, not asking you to tell the future, but just your opinion, right? Where do you see the insurance industry heading over the next few years? And then based on that, what advice would help investors stay ahead and protect their portfolios long term?
Well, one of the great things of what we do, because of all the different programs we continue to create and bring to market, we get a kind of bird's eye view of what's going on. We get to see the changes to the industry. We're help drive the change. The market has been in very bad shape in California and the Western United States. I'm just thrilled to be a part of what's going to fix it. So we have the fix. It's just now getting the information out and bringing more and more carriers to the table, including our own programs. And we're aggressively fixing that as we go. So I do think, I'd like to think we're getting towards the tail or the bottom, as I would say, the worst of it, while we fix things. I think we could be within the next 6 months or a year really turning the tides. We continue to do so, and with the expanding markets like we're doing for the depopulation of the Cal Fair Plan and doing a lot of the things that are going to help drive rates down, which will help consumers.
Got it. Awesome. Awesome. And just one more, I had this burning question that came up that I wasn't thinking about earlier, but in your opinion, like how does, and maybe you have some good insights on this from just your experience, but how do these wildfires in California, or even like in Florida, they've got all this stuff with FEMA and flood insurance that they require, and the hurricanes, like how do these natural disasters, I guess, that are changing insurance costs, at least locally, how does that affect the rest of the country? Does that kind of spill over to the whole industry because they're trying to spread their costs out across the industry, or does it really stay localized?
Yes. So that's good and bad, is what I would say. We have a very global view. So when we look at reinsurance, because there's different layers, you have a retail broker, you have then people that are the wholesalers / program builders, then you have the insurance companies, but there's a level that people don't realize that's out there. There's what's called the reinsurance companies. These are like the really large Lloyd syndicates and things that support the insurance companies. So those companies, obviously, when you have fires and you have floods and you have tornadoes and all the things, that affects the cost of insurance, the actual overall cost, because as those companies lose money, the rates go up. If they're making money, the rates slide down. And so, like an example, in 2025, we had a horrific start of the year in the Palisades fire, but the offset was there was no hurricanes that really landed on the East Coast. So the overall net was the market softening. As bad as the fire was in the Palisades, and as bad as the overall industry as a global view looks at it as, we actually had a pretty good year. And so that's, as those things drive factors, absolutely. When one part of the United States gets hit, it drives rates in other sectors because it's spread. It's the constant idea of insurance is spread of risk.
Yeah.
So obviously things like I was dealing with Colorado's Big I, that's the insurance. And they're talking about the legislation changes about how they're dealing with hail issues and how they have to have reinforced structures and how are they changing these things to help ease the cost of the insurance valuations. These are all things that as you get into different sectors or different sections of the United States, it affects the others. When one section's not doing what they do, it can affect others. And so it just becomes a spillover, to your point.
Got it. Yeah, I never really realized that until I had one person tell me that. I'm like, oh, that's interesting. So I figured I'd ask you about that as well, just to expand the knowledge. But yeah, makes sense. I mean, it does make sense, but
absolutely
not something that most of us think about, I think, day to day when we're looking at insurance. So
exactly.
Awesome. Well, hey, Robert, It's been great having you. We're pretty much out of time, but before we wrap up.
Oh, thank you.
Yeah, you bet, man. You bet. So I do want to give you an opportunity before we kind of conclude. Where can people find you? Where can people connect with you? What's the best way?
Absolutely. Easily. It's a funny name. We named it WOWS, WOWS Insurance. And we did it just to kind of have everyone open their eyes up, and it makes people curious as to what we are. So if you want to go to wowsinsurance.com, my email is real simple. It's robert@wows, WOWS insurance.com. It'd be great places.
Perfect. I love the name, and it's very memorable, and you can't screw it up. So that's a great.
Sticks with you.
Yeah, like
Exactly. Well, people, they'll make a mistake. They leave the S off. They'll leave the S off at
oh
times. I'll get,
man.
Robert, we can't get a hold of you. Well, and I look at it and go, well, you forgot the S. So we have fun
Oh,
torturing them a little bit on that kind of stuff.
nice, nice. Well, hey, it's
Yeah.
been fun, Robert. Really appreciate your time today. And yeah, great insights on the insurance world, man. I love what you're doing.
Always thank you for having me on today, and always welcome. I'd love to come back. Anytime you have any questions, let us know. I'd love to come back.
Sounds good. You bet. All right. Take care, my friend. Thanks for tuning in to this episode of the Cash Flow Authority podcast. We hope the insights shared today help you take the next step toward optimizing your finances and building sustainable wealth. If you enjoyed this conversation, please take a moment to subscribe on your favorite podcast platform and leave us a review. It helps other entrepreneurs and investors discover the show. And don't forget to catch the next episode for more insights. Until then, keep mastering your cash flow.